Okay. So now let's try to understand about discounting of notes receivable. But this is the situation without recourse, wherein the seller of notes receivable won't bond the losses occurred if the customer don't pay. So let's see the situation of HP Incorporation, where HP holds a notes receivable of $150,000, which is due in 4 months. Now HP discounts the note without recourse to a bank at a 4% discount rate, which means that HP went to bank and has given bank this note, and bank has charged 4% as a discount rate, or I can say 4% per annum rate. Now the bank advances $147,000 to HP immediately. How does this 147,000 arrive? Basically, we know that the discount rate is 4% and this note is due after 4 months. So this 4% is the per annum number, and calculating the 4 months discount rate will give 3,000 as a discount. Effectively, the note's value is $150,000. So the balance or the differential amount of 150,000 and 3,000, which is 147,000, will be received by the HP company from the bank. So since this discount is a without recourse discount, HP has no liability if the customer fails to pay. Now, if the customer who is going to pay after 4 months $150,000, if he doesn't pay, then simply HP won't have any liability. Why? Because the agreement will mention that this is a without recourse arrangement, wherein you can say this is a without holder's liability. Now holder has no liability. Without holder's liability, holder don't have any liability to pay off this in case of the customer fails to pay the amount. Now, the key point here is the note is removed from HP's balance sheet. Why? Because this is a transaction of sale of receivable. Actually, what is a sale? When something is treated as sale, you know that when risk and rewards are being transferred, ownership is transferred to other person, then this is treated as a sale. Now, the ownership has been transferred, but the debtors are also transferred here. Basically the debtors are transferred, and if the debtors don't pay, then HP company is not concerned at all. So this is treated as a sale, and if this is treated as a sale, simply it won't be shown on the balance sheet because this is a sale of receivable. Now let's try to understand the same thing through example, or not the example, basically textbook concept. So the discounting of notes receivable without recourse, textbook simply says that when a note is discounted without recourse, the holder assumes no further liability of the payment. There is no further liability for the payment for the holder, which the holder in our case was HP company. And the note is treated as sold outright. We treat it as like a sale transaction, and it should be removed from the balance sheet, directly removed from the balance sheet. Nothing is written on the balance sheet after that.